Hello and welcome to BQ Prime, ladies and gentlemen. I'm Hiral Daria. Joining us on the show is Jigar Mistry, co-founder at Beyond Capital, to discuss the stocks that are in focus in today's session. In fact, the cement pack is in focus on the back of the numbers that have come in. Specifically, you have an ACC, Ambuja, as well as Shree Cement that we're looking at. Jigar, my first question coming to you is overall, in terms of the cement pack, what do you make firstly in terms of the Q3 numbers for the three stocks that we're talking about? And what's your view?
Good morning, Hiral. First of all, thank you so much for inviting me to your show again. Uh, see, the cement 3Q numbers, Shree, Ambuja, ACC, I think Shree and ACC actually reported a decent volume growth, even Ambuja. So Shree's volume growth was almost 23%, Ambuja at 7, ACC at 3. But I think besides the volume growth, there was hardly anything to cheer, right? So EBITDA for all, at least Shree Cement and ACC was down about 14 and 30% respectively. Ambuja was marginally up, but I think it overall missed the analyst estimate. To some extent, the cost pressures, due to higher coal prices and inability of a lot of these companies to sort of pick up the prices has been weighing a lot on the sector. Secondly, if you look at the share price performance of majority of the companies in the sector, they are down anywhere between 5 and 10% for the year. Maybe SCC is down close to 20%. But even if you look at a slightly longer term path, they are, up about 30-40% over a 5-year period. And, we have long been sort of arguing that the cement sector, because of the way in which it operates with a pricing discipline, they are likely to face this perennial supply challenge that even if demand were to pick up, and that's been growing reasonably okay, your supply will always keep pace. A greenfield capacity that can be built out at $70 by any of these companies. And when secondary valuations are trading at, 150 to $250, depending on which companies you're talking about, then there is very little incentive for a lot of these companies to stop growing capacities, because every capacity you add at $70 gets valued anywhere between 150 to $250, and therefore just from a valuation standpoint, you tend to keep on adding capacity. The sector is in surplus for quite a while now. And I think if I look at the next 4 or 5 years, and including the announcements that's been made so far by Ultratech, Dalmia, Shree Cement, and even if I don't include the Ambuja or ACC because the guidance isn't very clear there, you're still looking at anywhere between 120, 130 million tons coming up for the next few years. So, it may remain a sector where longer term returns might continue to lag broader indices. Seasonally, 3Q will be the lowest quarter that you would see in a while. So, cement prices have picked up, coal prices have not. So, you might see some sort of tactical opportunities there. But I don't think, this sector can continue to demand a valuation that is much higher than what the street is paying to them at the moment.
Right. So overall, but do you think there is a possibility, taking into consideration, as you mentioned, the capacity additions that we're looking at, the outlay that the government has put forth in the budget in terms of the expenditure for infrastructure, plus we are talking of a GST rate reduction that could be on the anvil, where discussions are on with the government. And overall, with all of this, price hikes that could be probably on the cards as well, is there a possibility of a re-rating?
Right. So, see, demand, as I said, was never an issue, or not rather never, but has not really of late been an issue. So, if you look at the government spending, that's been consistently growing. And, the road sort of outlay doesn't really entail a very large cement usage. We don't really build out concrete roads for the NHAI, and they're largely bitumen roads. But at least, when the road gets developed, a lot of ancillary infrastructure gets created, residential houses gets created along the way. So there has been a multiplier impact, but demand has been broadly okay. The sector actually suffers from a perennial supply constraint, or rather supply issue, and that needs to be addressed. So, if everybody keeps adding capacity, how is it, demand supply going to get adjusted? So if I look back in history, 2003 to 2008 was a sort of golden period for the index when, the capacity utilization of the industry rose from somewhere around 84% to 94%. And that is the time when per ton EBITDA of the sector went up from 400 to almost 1,000 rupees per ton. Since 2008, even in 2Q, which was not that this bad a quarter, the
Hmm.
EBITDA per ton of the industry was still 1,000 rupees a ton. Right. So if it is such a strong supply scenario where the demand is so strong and supply could not even keep pace, then this 1,000 rupee per ton should have actually increased, right? Because at least there is some amount of inflation. The cost of building out a new plant has gone
Hmm.
up. The ROE that a 1,000 rupee generates, if you look at somebody doing M&A at $150, is less than cost of equity for most players. So it
Hmm.
is, it has been my long-standing argument that it is the only sector in probably the world where, the M&A happens at a price lower than listed companies trade at, right? For most sectors, there is a strategic acquisition premium. So
Hmm.
cement, apparently, there is a strategic acquisition discount because, players can set up capacity at 70. So that's the benchmark with which M&A happens. But secondary market investors are very happy to pay a higher price.
Hmm. Hmm. Right. So, Jigar, overall, would you recommend a buy at current levels, or would you advise an investor to hold and wait out for some more time?
See, we run a fund basically, so we don't give out advice. I can tell you what we are doing. We don't
Hmm.
have any of the three stocks that you have mentioned. The one that we do own within this sector is Dalmia Bharat,
Okay.
which has been having a reasonably decent quarter. That company did beat analyst estimates when they put
Hmm.
out numbers, and it's not trading at as expensive a valuation, right? So if you're
Right.
playing for growth, etc., that's the one that we do own. So yeah, that's
Right.
what you can take away from this.
Sure. Moving on, another stock that's in focus, which is seeing a good up move in today's session on the back of Q3 numbers, is a Cummins India. Now, clearly, they have seen a strong performance in terms of their industrial business, as well as if you talk about exports. Uh, Typically, if you see for a Cummins, it's usually Q4, which is a weak quarter, and Q3 is a strong quarter, and that's what is seen in the numbers as well. What do you make of a Cummins India, and what would your view be?
Right. So, I have to admit we were a little surprised with how well, 3Q has turned out to be. So, revenues, were up almost 26% YOY, driven by domestic. So, domestic was up 27%. EBITDA was up 50%. I think it was to some extent driven by, the lower employee costs. And if you look at the commentary that's been put out, I think they're saying that higher government allocation, infrastructure spending in the budget, transition from CPCB 2 to 4 plus, which mean that, your replacement demand will continue to remain strong. Our initial thesis on this name was that, look, if power demand in India is not going to be an issue, and with the GST, the compliance is going to improve, meaning, your requirement for the diesel set generators is not going to be as strong, then the people and the companies that are actually into the business of DG sets might, take a bit of a back burner.
Hmm.
That's clearly not something that has transpired, at least if you look at the 3Q numbers. But the management has, I think, not sort of given out any guidance. The stock sort of trades at 30p and 34 to be precise. And, if you look at the past 5 years, the stock's up 90%, but it's up 70% just this year.
Hmm.
Right. So majority of the last 5 years performance has come in this year. So prior to this, the stock was largely flat for 4 years. So one needs to actually look at it a little more closely as to where this demand is coming through and whether the margin improvement that we have seen from almost 15 handle to something like 18 handle, almost closing in on 19, is something whether it is sustainable or not. So we don't own this name yet. We are looking at what's really driving this, but an interesting space nevertheless.
Right. So that's with regards to Cummins India. Another stock that reported earnings is Honeywell Automation. Now, clearly, on a standalone basis, we've seen an uptick of around 18 to 19%. with regards to where profitability goes. And if you see in terms of the share price as well, uh, now there is a bit of correction that's coming in. 2.5% downtick is what we've seen on the counter. And in the last 1 year, it's a 14% degrowth. It's been a very volatile ride for a Honeywell automation. What's your view?
So Hiral, it's a fabulous company, right? It's done very, very well. At 30 odd thousand market cap,
Hmm.
uh, your earnings for the quarter, suggest some valuation numbers which are very, very eye popping. Just look at what's happening. So there is no doubt how well this company is executing, right? At this size, your revenue is up 18 odd percent. EBITDA sort of sort of was below consensus numbers at 7%, but they made it up towards as they made to PAT 18 odd percent, or slightly lower than what the consensus was expecting. Now, since the early 80s, if I remember right, this company has continued to sort of grow, surprise well. 10 years, your revenue sort of CAGR is 6 odd percent, but, they continuously worked on margins, profits growing in 10, 11, 12 odd percentage range. But what surprises me especially is how well stock price has reacted to it, right? So if you look at 10 years with a company that's generating something like 18% ROE, with a 12% PAT growth CAGR, your
Hmm.
stock is compounding at 30% plus. Right? Even in the last 5 years, it's up 122%. So it's doubled even when the earnings have not grown as materially
Hmm.
sharply. So, it does presents a bit of a dichotomy. The company is delivering, doing usually well, but valuations at 75 and 60 odd PEs leave very little room for margin of safety. So we
Hmm.
don't own this name as we speak, but if it were to correct beyond a point, it's always been on radar. We have historically owned this once or twice, but not at this valuation. So.
Right. Another counter that's buzzing in trade today is a trend. Clearly, a good growth coming in terms of profitability. Additionally, the consumption space as well. Overall, the anticipation is with higher disposable income in the hands of people on the way the direct taxes have panned out in the budget. There could be good opportunities coming in there. What would you make of a trend at current valuations? Is it a good time to look at the counter?
Right. He also, what, a 45, 46,000 crore market cap, sort of doing reasonably well today. Revenues were up a whopping 60 odd percent, but I think a large part of that was driven by how well Zudio is doing. It's their answer to that low ticket, the Generation Z category that they are trying to cater to. EBITDA grows at a cool 15%, profits at 20 odd percent. Even West Side, right? West Side, same store sales growth is coming in at around 17 odd percent. So what we are seeing is that Trent has been able to sustainably move away. In the traditional business, it's still growing at 17, huge double digit, which is a very good number. But it has been able to move into this Gen Z market and been able to cater to this 500-600 rupee t-shirt market, right?
Hmm.
And that is driving the growth. So, I think most people will be sort of looking at this number positively, even though optically it looks like EBITDA margins have shrunk, but that's largely driven by higher Zudio mix and slightly higher revenue, sort of employee cost, which is, as they build out the store sales incrementally, your employee cost comes sooner. If I take a step back and look at, past next 3, 4, 5 years, then the model that has managed to do well, just not just in India, but let's say even say Zara. Right? Zara has been able to is one of those very few formats that been able to adapt continuously to the changing requirements and
Hmm.
manage their inventory very well. I think a trend to that extent has been able to plug into that Zara model. Maybe it's their learnings from their understanding
Hmm.
with Zara, or they've been able to cater to this fast fashion reasonably well. And I think that will keep the sort of multiples elevated to some extent. West Side is one of the oldest formats and doing very, very well. Valuation terms, if you do the SOTP, include Star Bazaar, include Zara,
Hmm.
that's adding something like 3 odd hundred rupees, 1,000 odd rupees is a decent valuation for standalone. So optically, it does look a little more expensive, but I think the company is executing beautifully well. We don't own the name right now. We have owned it, especially after the wave two. But it's clearly a company and a business that knows how to execute, how to cater to changing demands, and clearly doing very, very well.
Right. And the last stock that we want to discuss, Jigar, is a Pyramid Enterprises. If you see the profitability, a number of 3,554 odd crores, revenues have seen good growth. In fact, the profitability has seen a rise manifold. What we make of a Pyramid Enterprises, the stock has been under pressure as well, because if you see in the last 1 year, a 60-65% of a downtick is what we've already seen on the counter.
1 year, Hiral, it's little difficult to say because the Piramal Pharma got demerged, so I don't
Demerged,
really
yeah.
know. Yeah, I don't really know how to look at it. But you are right. See, optically the numbers look okay because NII grew just about 5%, non-interest grew 25%, and despite that, your employee cost, sorry, my bad, the operating expenses is almost coming in at 3.6% of assets. That's a huge number, right? So despite your fee income growing strongly and NII, 5% is neither here nor there, your PPOP is down 9% YOY. So that itself, the operating numbers, that despite non-interest income growing 25%, your PPOP is not able to keep pace. Add to that the credit cost, which is almost 17 billion for this quarter. Compare that to NII of 32 billion. Those are massive numbers. Admittedly, 17 billion does include some provisions that are taken out of cautionary basis. But this is coming on the back of one, even last quarter, if I remember right, was a reasonably bad number. Your stage 3 is doubling at 6.5%. Your stage 2 plus 3 still remains high at 19%. And profit growth was driven, I think, largely by those tax reversals, which one could say were one-offs. So, if you take a step back, the stock, your book value, basic book value today is $1,000. If you remove Shriram and the other businesses that they own, the stock in the standalone basis are available at 600 odd rupees. So it's not an expensive stock, but management keeps guiding at 1 to 2% credit growth, whereas the actual credit cost is coming at a very elevated level. And when in comparison, if you look at a lot of banking results that are coming out, the credit cost is totally benign, right? So it appears as if the old books are yet to settle down in terms of the positioning, the sort of vintage recognition that needs to happen. And I think the street will be a little wary as to when the sort of thing bottoms out. The large part with this is that on one hand, when you have good quality NBFCs which are reporting very benign credit cost available at say 0.7, 0.8 times, and good quality banks at about 1.2 to 1.4 times, here you're looking at a 4%, 5% ROE business at 0.6 times. Would you rather not prefer a 0.9 to 1% ROA, and if it's a bank, the leverage can be much higher. So you're looking at ROE of 12 to 15% available at 1.2 times, vis-a-vis buying a Piramal enterprise where credit cost is still not adding up to what management commentary is. So yeah, it remains to be seen. We don't own this clearly, but it's interesting to watch out for it.
Right. All right. Thank you so much for sharing your views, Jigar, with us and the viewers to understand all these stocks that are buzzing in trade today. Thank you. Stay safe and speak to you soon again.
Thanks. Bye.